The economic situation today is poor. We've been running continuous deficits in the UK for 25 years now. We are operating well below our potential and our capacity. Maybe it would actually be just easier if the whole thing just imploded. Keir Starmer caved in over the benefits reform bill, and at the end of his first year, he's essentially lost control. You're in danger of cutting the system off at its knees. So you just gradually wither and die.
How optimistic. Welcome to Algy's Investment Podcast, and in this episode, my guest is Alastair Irvine, who has been Investment Director at the Jupiter Merlin Team for the past decade. And I'm hoping I'm going to persuade him to come every 6 months to talk through his global macroeconomic thoughts and insights to give you a guide as to what is really happening in the world outside of just investing in equities or bonds. So, Alastair, thank you so much for joining us today.
Well, that's a pleasure, Algy. Nice to see you. Thank you.
Being the investment director of the team, you wear a number of hats, but what do you think is your greatest skill that you help bring to fund manager meetings?
So I think it's an ability to distill what's going on in the world down into a relatively straightforward, not simple, but straightforward and easily digestible format that they can just take away and synthesize with all the other stuff that they've got coming in from other people and present that to their clients. We think that we're much better actually at finding managers who are real specialists in their particular areas, whether it's UK equities, US equities, global equities, value investors or growth investors or bond specialists or bond generalists or whatever it is.
Over and above buying cheap index trackers.
Yes. Who can do that job for us.
Yep.
Yeah.
Okay.
And what we do, the value that we bring in that is identifying those managers who can do that job that we then synthesize into portfolios and they make money for clients. And what you're trying to do within that level of risk that the investor's prepared to take is to give them as smooth a ride as you possibly can. So you actually want things that to an extent complement each other, not cancel each other out, but you're blending things that allow that performance to come through without giving you the full exposure to the downside. And it's protecting on the downside that's really important when it comes to that compounding long-term wealth. You're trying to keep up in the good times, but critically not lose as much in the really difficult times. And if you can do that, you're pretty well home and dry.
Now that is a literal gem. Thank you for that, Alastair. I love that. Lose less in the down times and keep up in the good times.
Keep up in the good times, lose less in the bad times.
Now let's move on to UK politics and economics, because I know you love a bit of politics in the UK.
We're paid to give opinions, Algy.
Well, you are paid to give opinions, and let's start off with your opinion of the UK Chancellor, Rachel Reeves, and the preparation of her second budget, which is not too far away.
October.
Having promised that she would get the UK finances back on track and restore economic growth, what chance do you think she has of fulfilling her promise without raising taxes for working people?
For who? For working people. Well, there in itself is a question. Because, of course, the government on the stump got itself completely tied in knots, or the Labour Party did before it was elected, about who the working person is. I think they have a very different assumption about who working people are from who the rest of us might have that appreciation of. So in their eyes, am I a working person or am I here to be milked? Are you here to be milked? You're a working person. Are we? Do you see what I mean?
It's not clear.
It's not clear. So
there are 25 million people in the UK that are working, full-time employment.
Yep.
And they've got a massive great hole in their budget.
Yeah.
What's going to happen?
So she's got herself between a rock and a hard place here. And although it was very convenient early on, before the first budget, before last October, to blame everything on the Tories, and undeniably she inherited a very poor hand. But what she has done since then is to double down on it, and has made life considerably more difficult for herself, such that by the time we get to the second budget this October, she's really dealing with problems that she has made for herself. So if you just job back to last October, she was very clear. She kept drumming it home in the House of Commons when she was making her statement that these are my choices. This is my budget. We are now resetting the economy, expunging all those years of Tory chaos. But today we find that we really haven't got any growth. She's already on the hook to have to borrow much more than she thought. She doesn't control growth. So let's just take it back to its basic principles. The government's got two levers that it plays with. One is the amount of revenue that it generates through taxation, and the other one is how much it spends. It's supposed to control how much it spends. It has a strong influence over how much it generates, in that it sets the rates of taxation for VAT, income tax, national insurance, corporation tax, all the other taxation rates. But it doesn't actually control what the take is, because, of course, there isn't an economic activity dependence on that. The stronger the economy, the more tax you generate. The weaker the economy, the less. The difference between the two is that you either have a surplus, so you've taken in more money than you've spent, in which case that then gives you options about what to do with it. You might choose to spend it somewhere else, or you might choose to pay down debt.
Yeah.
If you've got a deficit, then, of course, gradually you start to reduce your choices, because you find yourself sort of rather boxed into a corner. And that's particularly the case today, because we've been running continuous deficits in the UK for 25 years now. The debt has been going up and up. And today, partly symptomatic of that rising pile of debt, and partly symptomatic of the absence of a clear plan as to how to reduce it, when actually all the indicators are it's going the other way, is that the markets are forcing up the cost of that debt. So that becomes an additional compounding burden in its own right, in weakening the government's financial hand. So when you then just think about who her main, as you might call them, you want to call them stakeholders or interested parties, whatever. It's the electorate. And as you said, she's promised not to raise taxes in the way that you would promise not to increase the rate of income tax, or the rate of employees' national insurance, or the rate of VAT.
Yes.
There are many other ways of skinning that cat. But when you've made a fundamental promise to the electorate, and particularly working people, that you're not going to screw them, you've got a real political problem if you then have to go cap in hand to them. Then you've got the public sector unions. So one of the first things that Labour did, partly to resolve that industrial unrest that there was at the time, people like the train drivers, the BMA, various other parties, was simply to give them a great big pay rise with virtually no strings attached. So there were no conditions applied. And here we are today, finding that the BMA, the junior doctors, are coming back for a second very large bite of a very large cherry. So they are an interested party, clearly. The other one, of course, is the bond markets, sitting where we do. When she has said that her fiscal responsibility is to borrow responsibly and to look after the finances responsibly, and she's laid down her fiscal rules that day-to-day spending will be met out of taxation, and that investment will be made out of borrowings. When you really start pushing up against those stops, and the market doesn't actually believe that is a sustainable proposition because of the evidence of what is in front of it with the way that the numbers are going, then that puts strain on that relationship, which of course is essentially the bond markets acting as marking the government's homework through the bond yield.
Through the bond yield.
And then the last one, of course, is the Labour Party itself, Labour backbenchers. And since that disaster in June, where Keir Starmer caved in over the benefits reform bill, which was supposed to save whatever it was, 5 billion quid.
Yes.
And here, Algy, we're not talking about saving 5 billion quid from the current level of benefits expenditure of 47 and bring it down to 42. What we're talking about is saving 5 billion quid on a sum which in 2029 is forecast to be 77 billion, and trying to keep it down to 72. So having lost that, having effectively faced with 174 seat majority, it's not actually a working majority that's that big at the moment, but nevertheless a stonking great majority. And at the end of his first year, having already been challenged in what was very rapidly becoming a vote of no confidence in the government, led by his own side, he's essentially lost control of his backbenchers. They are now telling him what are the limits of what is permissible when it comes to controlling government expenditure. So she's a real jam.
So just to answer a couple of questions quite succinctly, what percentage of our GDP is generated by the public sector?
Is generated by the public sector?
Yes.
Well, it's not a lot. So what you have to understand about the public sector is that the public sector essentially recycles taxpayers' money. It supports economic growth.
It doesn't create it.
But it doesn't create it. It is a vibrant private sector that drives economic growth. So it is definitely part of GDP, but it's not the engine of growth.
So the engine of growth is the private sector.
The private sector. Yeah.
So it's question number 2.
Yeah.
Currently, what percentage of GDP do we spend in the UK on interest rate payments?
Just over 4%.
Just over 4%.
Yeah.
And is that greater or smaller than our defence spending in the UK at the moment?
As our defence spending is right now today, we spend 2.3% today. So we're spending nearly double on the interest payment that we are on our defence. But the really important thing here, Algy, is that the Office for Budget Responsibility, which annually brings out a long-range projection based on what it knows about government expenditure and based on what it knows or assumes about long-term trends, particularly to do with things like demographics. And remember, the OBR it's the arbiter of government fiscal probity.
Of course.
Yeah. It's a quasi-regulator.
Yes. And what's it saying?
It is forecasting that on our current trajectory, by 2075, we'll have debt to GDP of about 275%, and we'll be paying 12% of our GDP in interest charges.
So something has to change.
Quite
dramatically.
And the tipping point, according to the OBR, and the numbers will be wrong.
Yes.
It's the trend that's important. The tipping point when the debt and the deficit and the interest payments become almost like a runaway train.
Yes.
Is about 2050. It's not long.
It's not long.
And once it starts to run away, it's almost impossible to get it back.
So go back to 1976.
Yeah.
And the UK government went cap in hand to
Dennis Healy,
the IMF,
Yep.
to basically get our finances back in order.
Yeah.
And our debt to GDP was 50%.
Yeah.
It's currently
96%
and
and heading up.
So what are the chances of the UK going back to the IMF at some point in the future?
So you ask an interesting question, because before 2008 and the global financial crisis, the concept of quantitative easing had not been invented. So if you remember back at that big crisis point,
yes,
in 2007 to 2010, the central banks were their entire priority was about keeping the system alive. We were facing a potential systemic meltdown. It was, what can we do here as central bankers to keep this show on the road and prevent it imploding? And what they did was, colloquially, to print money. Now, to those of us of a certain generation, printing money had all those connotations of what happened to Germany in the 1920s and 1930s. You know, if you add a gross tidal wave of liquidity into the system, what you do is you create inflation. Well, it didn't happen. It didn't happen. It was skillfully manufactured that rather than just crudely printing pound notes, that the Treasury would be able to issue debt. It would issue it to the market, and then the Bank of England would buy that debt from the market. So, but nevertheless, what it did was it stabilized the situation. What would probably happen now is that the authorities, the central banks, faced with this sort of meltdown thing, would probably go back into QE mode of some variety.
Of printing money.
Printing money. Now, the central tenet of this, of course, is that we live in a fiscal economy. We live in a fiat economy. It is all based on trust.
Paper money.
It's
not
money.
Backed by gold or anything like that.
It's not backed by gold because there isn't enough gold around to support the amount of gold that exists does not cover the outstanding liabilities.
Okay.
So it's all based on trust, and it's that trust of if I'm a treasury minister, and I need to issue bonds, is there somebody out there who will take them from me because they think A, that I'm good for the interest, and B, that I'm actually good for the money at the end of it? Yeah, and that is an indefinable quality. Trust. It's completely ephemeral. You can't put your finger on it. You can't draw it. You can't touch it. But in the absence of it, the whole system then starts to collapse. And it's when you reach that breach of trust, or that trust just simply disappears, and there's no one in the market, or there's no other counterparty government who is willing to take your paper, that's when the authorities, the official authorities, not your central bank, but the IMF and others,
they come in,
stand and they take control.
Right.
Yeah.
What would a wealth tax do to the UK today? A lot of people have already left the UK.
Yes, they have. Yeah.
Would that brain drain continue to slide away from our shores?
I think it would. So there are two bits to it. One is the brain drain, that intellectual capital that you would lose, and the other one, of course, is the financial capital. So those kinds of people are quite mobile. They will move to protect their wealth, and as you rightly say, we've already lost, I don't know what the precise number is, was 11,000 or 19,000 highly wealthy people who've taken their capital and their expenditure with them, and of course, when you've got the top 1% of taxpayers who account for 28% of all income tax, you're in danger of cutting the system off at its knees.
Yeah.
The other thing about those wealth taxes, of course, is that it destroys aspiration. Because if you know that once you get up to a bar, that beyond that your wealth is going to be taken off you, unless you're sitting on vast amounts of cash, you might actually have to start selling assets to raise the cash to pay the tax man. But it means also that you're probably going to sit there and think, well, if these numbers still don't add up in 3, 4, 5 years' time, are they going to come for me again? So suddenly the 2% becomes 2.5%, and the 10 million has become 9 million. Then suddenly you're in a very, very different position. You're having to more than double the amount of tax that you're going to pay. So you will then stop aspiring to accumulate capital. And then it sucks capital, it sucks the life out of the system. And your economy starts to ossify. It then puts much more, going back to your question a few minutes ago about the public sector, it then puts more emphasis on the public sector to keep the show on the road. But as I've said, the public sector itself does not create and generate wealth. So you end up gradually sinking into an accelerating economic vortex. I mean, it sounds slightly hyperbolic and a bit dramatic, but what it essentially means is that you lose international competitiveness. Overseas investors really can't be bothered with sticking their money into an economy that's just going to drain away the rewards. And even if it doesn't drain away the rewards through additional frictional elements, it's going to confiscate them at the other end. So why not go and invest them somewhere else where you get a higher reward? So you just gradually wither and die.
How optimistic. I saw the other day. I saw the other day that the UK was described as Poundland.
Yeah,
and of course, we don't need to go into too much detail, but one thing that is great value and continues to be great value is the UK stock market.
Yes.
And the Merlin team, have they got quite a lot of exposure?
Yes, we've still got a lot of exposure to the UK.
Have you?
Yeah.
And that is because
to the UK market.
To the UK
market. Yeah.
Which of course doesn't mean
not necessarily the UK economy.
They can be international companies that happen to be quoted in the UK market and are at quite reasonable discounts to their comparative companies overseas. Yeah. So it's not all doom and gloom.
No.
There is a stock market there.
Yeah.
We have some great entrepreneurs.
And actually, Algy, this is part of the thing. So I'm talking in slightly apocalyptic terms here, but the economic situation today is poor. It's not dire, but it's poor. The buses are still running, the tube's still running most of the time. You and I saw each other on the train this morning, which was running on time. The world is still turning, but we are operating well below our potential and our capacity. But we're not making any progress towards closing that capacity gap. The capacity gap is actually opening. So it's gradual, it's imperceptible. And actually, in some ways, this is part of the problem. Maybe it would actually be just easier if the whole thing just imploded. It would be extraordinarily painful for all of us at the time, but it would allow a fundamental reset rather than just this drift.
So my final question about the UK is there any other party, before you just give Labour a really tough time, is there any other party that is capable right now of doing a better job?
No. So if you take the great swathe of what is on offer, whether it's Tory, Labour, Lib Dems,
Reform.
SNP, well, Reform we'll come to in a sec.
Okay.
All of those are variations on a theme of Keynesian economics. It is broadly about tax and spend. They do have nuances between them, but what we have today is simply a more extreme version of a continuum of what we had under the last period of government from the Tories, including that period of austerity.
Yes.
Where, incidentally, on that period of austerity, we simply slowed the deficit. We did not reduce the debt over all that period, despite what you think about all those huge savings on public services and things. The debt still grew. Reform's really interesting because it's a mongrel. It's a mongrel party. So it's got some very right-wing views, and it's got some really quite fundamentally left-wing views, particularly when it comes to things like public services. So although Farage and his team would try and cut the benefits bill quite significantly, most of the other spending departments, particularly the NHS, would still get a vast amount more money. I mean, one of the things that I find ironic about reform is when it comes to its economic package, outside benefits, there is actually very little reform involved from a party that might not necessarily do what it says on the tin. And the other problem with reform is that it is simply, at the moment, it is the lack of intellectual rigor behind its numbers. So if you, slightly tragically, I did actually read its entire contract with the electorate, its manifesto last year, and I took its numbers apart, and you simply cannot get them to add up properly in a way that gets the debt back under control. The deficit would still grow; it would simply grow more slowly. But where it pins a huge amount of hope is on growth. But governments don't control growth. They can try and influence growth, but they don't control it. So if the growth is your get out of jail card fiscally, you're immediately somebody's hostage.
One of the key ingredients to ensuring you have a strong manufacturing base is that you have a cheap and plentiful supply of energy.
Reliable energy.
Which in the UK, of course, we simply do not. But I did see a ray of hope this morning in the paper when I read that Ed Miliband had given the green light to a £38 billion investment into Sizewell C, I think it is.
Sizewell C.
Nuclear power station, which will take God knows how many years to get up and running.
Yeah.
Now, I remember you saying some time ago when we had the capping of the energy prices.
Oh, yes.
A couple of years ago when
2022,
when the Ukraine war started, that they could have done quite a lot of good with the money which they spent, the government, the Tory government spent on capping energy prices. How much did it cost them to cap those energy prices, and what could they have done with that money that would have been a lot more productive?
Yeah, so I don't know how much it actually cost in the end, but Liz Truss set aside 175 billion quid to cap the cost of electricity and gas, not to fix your bill, but to fix the unit cost.
Yes.
Yeah. And that was for 6 months. 175 billion quid. I mean,
that's a lot of cash.
Eye-watering amount of money, Algy.
Yes.
The Rolls-Royce small pressurized reactors, which are modular. These are modular units. At the time, so this was 2022, were priced at magically 1.75 billion pounds each. So quick reform type, back of the envelope, back of the fag packet calculation here. You could have bought 100 of those and added about 40% to our total structural generating supply, permanent generating supply, which would have lasted possibly for 50 or 60 years for the same amount of money that the government was prepared to set aside to fix the price of electricity and gas for 6 months.
Unbelievable.
Now, of course, the flaw in that argument is that those pressurized reactors don't actually exist at the moment. No. And you can't just ring up Rolls-Royce and say, I know, I'll have 100 of those. Can you deliver them on a wagon tomorrow? It doesn't work like that.
But it is investing in growth.
But it's about investing in growth.
Yes.
So there's just one point to make about that Sizewell C thing in terms of the 38 billion. that money is going in. That project will be completed. It was supposed to cost 20.
Bit like HS2.
Yes.
Right, we've done enough. We've done enough on the UK.
Yeah.
Let's talk about the States. And if I'm going to be completely honest, Alastair, I'm often confused by Trump.
Aren't we all?
No more so though than his change in approach to the war in Ukraine.
Yes.
Because it has gone. He has waxed and waned as to how he's gone about it, particularly more recently. Does President Trump now realize that Putin cannot be trusted? Because he's tried 4 times to create a peace agreement, and every single one has failed.
Yeah. Yes, I think the scales have fallen from his eyes. I think they finally have. I think he's finally worked out that Putin is untrustworthy and a wrong-un.
Thank God for that.
So what he's in fact done, having realised that, is a complete 180 degrees turn in his approach to Ukraine. So when he was on the stump, he was absolutely adamant that he wasn't going to give another dollar when he became president to supporting Ukraine. And as he announced recently, he's now going to start sending weapons to Ukraine again. So the argument now is about whether they should be offensive weapons or purely defensive weapons. So it partially takes you back to where we were under Biden, which is as far as Zelensky's concerned, he's back in the game again. I mean, that man is just extraordinary. He's been living on his wits and on some warfare benefits and charity handouts for, where are we now? And midway through 2025, 3.5 years. And he's kept the Russians at bay, but he can't push them out.
No.
So potentially what Trump's done is he's keeping Zelensky in the game, but he's not giving him that ability to land a knockout blow.
Okay, that's very interesting.
But it's a very significant change of heart.
Talking about weapons of war, Warren Buffett said that trade tariffs are in some ways a weapon of war.
Yep.
And the president needs to be very careful about how he goes about these trade tariffs. Is Putin dangerous? Sorry, can I say it again? Is Trump himself dangerous to world peace?
Is he dangerous to world peace? He's a conundrum, Algy, isn't he? Because everything he does is about activity focused on him. So to that extent, he is a destabilizing influence. Is he a danger to world peace? He is an agent of instability, which paradoxically has created some new stability. So if nothing else, what he has done with NATO is to force the Europeans and Canada to confront their own shortcomings when it comes to defense. The other side of what, it's not just Trump, but it's the Americans. The Europeans have been quite lily-livered about it, but it really is about the Americans. Because remember, it was Biden who branded Russia, China, North Korea, and Iran as the axis of evil. They're a force of evil. Between the two administrations, but in their own very different ways, what has happened is that axis has formally coalesced. And the thing that brought it, that real formality into fruition, was a joint communique that was put out on the day after VE Day.
Mm-hmm.
The joint communique that was put out by Xi Jinping and Putin about their joint view on global stability. It was a pretty odd way of doing it, because there was breathtaking bravado in their view of stability, bearing in mind that the Russians are trying to occupy Ukraine, and the Chinese want to recover Taiwan by whatever means. Tried telling that Ukraine and Taiwan that this is a stable world. But what it did was to put lines in the sand. They were putting markers down jointly as partners that this is how far you can go before you might expect a reaction. And that in my view was actually quite a seminal moment.
Okay.
What Trump should get credit for, though, is what he has been trying to do, and this is a continuation from Trump 1, is what he's been trying to do to repair relations across the Middle East. So in his first term, he had put together a reconciliation program called the Abraham Accords that brought together what had previously been irreconcilable Middle Eastern interests with Israel. That was a major step forward. If he was ever going to get a Nobel Prize for anything, that might have put him on the list. And although things have clearly moved on a significant amount since he left office the first time round, not least the fact that we've got a war raging in the middle of Europe, it is that he's still trying to foment stability in the Middle East, which includes confronting Iran.
Well, that's my next question, because why did they choose to bomb those three nuclear development sites when they did? They could have done it at any point in history, but there was obviously great collusion with other parties.
Yeah.
And they decided to do it there and then, and there have been to date no repercussions.
Yep.
What happened?
I think it was simply that the Israelis took matters into their own hands anyway. They're sitting there faced with an existential threat, and so they had decided unilaterally that they were going to try and, in the military terminology these days, degrade Iran's capabilities. What they didn't have was the ability to do those really deep underground installations that required these American MOPs. It's a wonderful term, isn't it?
A MOP.
MOP. A MOP. Massive ordnance penetrator.
Is that what it stands for?
Yeah. It's a sodding great bomb. But I think the critical thing in this was the joint collaboration in the intelligence services, and the outcome of which was this realization that Iran was getting very, very close to being able to stick a viable warhead onto a rocket and hit pretty well anywhere in the Middle East.
Okay. So moving on to the dangers in the world. I mean, the world is a more dangerous place than it's been since probably 1990.
Mm-hmm.
We've spoken about Taiwan. We've spoken about, very briefly, and we've spoken about Ukraine.
Yeah.
But is there anywhere, and we've spoken about the Middle East as well, where do you see the world being at its most dangerous today? Is it the Middle East?
Well, the Middle East is a permanent tinderbox.
Yeah.
So you've now just in the last week seen that that hostilities have broken out again in Syria after the change of regime there at the back end of last year. So the Middle East is unstable. It always has been unstable. It becomes more dangerous when interested parties are involved. Where else could it go wrong? Well, of course, the big argument is about what Putin does next. So in terms of the military threat, the big debate is what is the outcome of Ukraine and what does he do next? The one thing that Putin has not stepped back from is his strategic aim of building a politically and militarily sterile buffer zone from the Baltic, actually now it's from the North Cape, all the way down to the Black Sea, that physically separates the EU and NATO from the Russian sphere of influence. Mm. So whether it's Belarus and the Russian motherland and wherever else, and that would include those areas that are under threat, not just the frontier countries, but also Moldova and Georgia, who are both non-NATO members, but would like to be members of both NATO and the EU. Putin will simply regard that as another threat. So does he want to confront NATO head on? I don't think he does. I might be wrong. I don't think he does. He will subvert NATO in any way that he possibly can. But I think he could have a go at both Moldova and Georgia as potential thorns that he could do something about. But the received wisdom is that Russia is the most immediate military threat. Of course, the thing that's changed since which is a miscalculation of his, the thing that's changed as a result of his invasion of Ukraine is that Sweden and Finland have now joined NATO. They were neutral countries. So there is now, as of 18 months ago, a new 830-mile direct border up in the north between NATO and Russia. And critically, at its narrowest point, it's only about 120 miles separating NATO territory from the main bases of the Northern Fleet, the strategic nuclear fleet at Archangel and Murmansk.
Okay.
So NATO really is quite preoccupied that in one way or another there may be military incursions that could extend all the way from Finland and the Baltic states, which Russia still feels very proprietorial about, that may then extend down through Poland and Romania and on its way down to the Black Sea.
Goodness, it does worry me. The bond markets around the world.
Yes.
And the bond markets, let's be completely clear here for our listeners.
Yeah.
The bond markets have always been the canary in the coal mine for the equity markets. What are the bond markets around the world which you're watching telling us right now?
That the long-term future is a great deal less certain than it was. But it's perfectly right. So what we've seen over the last year is a significant steepening of Western bond yield curves,
which translated into English
means they now go from bottom left to top right.
So it's getting more expensive,
and that is entirely rational. Mm-hmm. So if you're here at the this microphone out of the way, but if you're here at the short end of the curve, sort of 1 and 2 years, you've got a reasonable idea of what might happen. When you're out here at 10 years, you've got rather less idea. When you're out here at 30 years, you've got no idea.
Correct.
So it is entirely rational from an investment perspective that you would expect a higher rate of return, a higher yield on your investment for a long-term commitment than you would at the short term.
Yes.
But what has happened over the course of the last 18 months is that whereas previously we had bond yield curves that were inverted,
yes,
that were utterly preoccupied with the possibility of a more or less immediate recession, particularly in the US. When that didn't happen, they then started looking at what the shifts were in not only the economic situation, but also that growing geostrategic instability. Yeah. And you start pricing in what is the risk that it goes wrong, that the wheels drop off. What is the risk that I don't get my money back? And if I'm less likely to get my money back in 30 years' time, I'm happy still to lend it for the moment, but I do want a higher rate of return. So that's really what the bond markets are telling you today. It is that they're relatively sanguine about the short term, but they are really preoccupied, particularly by the amount of debt and the inability of governments to get that debt contained and down, even in the States.
So they are being completely rational.
They're being completely rational. And it's interesting, isn't it, that just to finish on that point about the debt, that when Trump presented his one big beautiful bill, he really did call it that. It's bonkers, isn't it? His one big bonkers beautiful bill, which got through the Senate in the same week that the benefits reform in the UK didn't, and Trump had virtually no maths on his side, and Starmer had 165-seat majority on his side. One's a leader and one's not. I mean, it doesn't matter whether you like the man or not. He can make things happen.
He can make things happen.
Is that when you take all the measures that he included in that, so it's all the cost savings from Elon Musk's Doge when he was there, it's the savings on the Medicaid bill, but there's huge investment in things like infrastructure to support AI, defense, big tax cuts. You take all that together, the US debt ceiling is going to go from $36 trillion today to over $41 trillion by the time he leaves office. And the bond markets are quite preoccupied with that. And that's why they've jacked up the cost of debt.
And let's just to talk about currencies for a second, because it's never been something which has been big on your radar.
Mm-hmm. Forecasting currencies is a mug's game.
But is the dollar? Is Trump trying to get the dollar weak?
Yes.
And why is he trying to get the dollar weak?
Because it's entirely consistent with what he's doing on tariffs. If you make the dollar weak, what you do is you make if you make your own currency weaker, it makes your imports more expensive. What's the idea of tariffs? To make his market less attractive. So the two are entirely consistent.
And what is the outcome then for the opportunity in emerging market equities?
Well, there are two parts to that. One is related to the dollar, and there has always been this fairly strong inverse relationship between what happens to the dollar and what happens to emerging market equities. And the other, of course, is it's not just about currency. It is also about their own economic outlook, and geostrategically, led by India and others, those countries which now brand themselves as the global South have put down their marker that A, they want respect, and B, they think they're the future. And so, they competitively, they are pushing on, and they will continue to use whatever tailwinds they have, particularly with things like demographics and population growth and technological advancement, to improve their lot. They are improving their own competitiveness. And they want to win too. This is a competitive world. Man is a competitive beast. Everything we've talked about today, to a greater or lesser extent, is about competition.
That is so right. And to finish off, as we're talking about competition, and the success of the Jupiter Merlin team.
Yeah.
Where are the Jupiter Merlin team placing their faith with their equity managers geographically? So in which geographical regions are they more positive, and in which geographical regions are they more neutral?
So the two areas, so we now rather differentiate, because I think when you're looking at funds that you invest in, and particularly ones that would show up, say, on a fact sheet, it is where those funds are badged. Yep. So we have quite a big exposure to the UK in terms of badged funds.
Mm-hmm.
You will find lines saying, blogs UK Equity Fund or UK Income Fund or whatever it is, and we've got Japan.
So you like the UK, you like Japan.
We have Japan. Outside of that, we have no European badge funds, and we now have no US badge funds. But we still have a big exposure to the US, and we still have quite a reasonable exposure to Europe indirectly. But that's now effectively being subcontracted through the investments that we've made in global fund managers. So from that point of view, what we've actually said is you go out and find the best countries in the world. Yeah. If they happen to be in Europe or in the US or in India or wherever they are, you invest in those. You find the best companies to do the trick, whether it's from a value perspective or a growth perspective or whatever investment style that manager has that has attracted us to them. You go and find the best ones, and we're agnostic. I'm not going to say we're not particularly bothered. We're agnostic about where they happen to be. What we are still interested, of course, is what our look-through exposure is, because that still does matter. But it is a byproduct of investing in those global funds.
And then finally, Alastair, my last question is, I would love it if you would come back in 6 months' time and we can make this a regular Algy and Alastair global macro show.
Well, that'd be great, Algy.
Would you come back in 6 months?
Absolutely, of course I will. I'll sit here and talk for hours. You know me.
Right, absolutely. Done deal. Thank you very much for joining me.
Thank you so much.
All content on the Algy's Investment Podcast is for your general information and use only, and is not intended to address your particular requirements. In particular, the content does not constitute any form of advice, recommendation, representation, endorsement, or arrangement, and is not intended to be relied upon by users in making or refraining from making any specific investment or other decisions. Guests and presenters may have positions in any of the investments discussed.